The famous billionaire Warren Buffett just sold $75 billion worth of stock in one quarter, and the majority of it was Apple. That's right. One of the world's greatest investors is pulling back from one of the most valuable companies on the planet. What's behind this bold move? Should you be worried about your investments? And what does this signal about the future of the U.S. economy? Stick around, because today we're diving deep into Buffett's decision, the fears it has ignited, and what it could possibly mean for you. Welcome back to the Business Builder's Guide, where we break down the latest financial news and new forms of income to help you make informed decisions with your money. If you're new here, don't forget to hit that subscribe button and ring the notification bell so you never miss an update. Today, we're tackling one of the biggest financial stories of the year 2024, Warren Buffett's decision to sell a massive $75 billion worth of stock in just one quarter. With Apple making up the lion's share of that sale, this move has sent shockwaves through the markets, sparking fears about the future of the U.S. economy and raising questions about whether now is the time to reassess your own investments. But before we dive into the details, let's take a moment to understand why Warren Buffett's actions matter so much. First, who is Warren Buffett, often referred to as the Oracle of Omaha? Warren Buffett is one of the most successful investors of all time. As the chairman and CEO of Berkshire Hathaway, Buffett has built a fortune through a disciplined approach to investing that emphasizes value, patience, and long-term growth. His net worth currently sits at over $100 billion, making him one of the wealthiest individuals on the planet. Buffett is known for his simple yet powerful investment philosophy, encapsulated in quotes like, Rule No. 1, never lose money. Rule No. 2, never forget rule number 1. And it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. His strategy focuses on buying high-quality companies with strong fundamentals at reasonable prices and holding them for the long term. But even the Oracle of Omaha isn't immune to the challenges of the current market. So, what drove Buffett to sell such a significant amount of Apple stock? 2. Breakdown. Let's look at the key reasons behind Warren Buffett's decision to sell $75 billion worth of stock, particularly his large position in Apple. Concerns about future tax hikes. One of the primary factors influencing Buffett's decision is his concern about future tax hikes. The U.S. government is facing a massive deficit, and Buffett believes that taxes, particularly on capital gains, are likely to rise in the near future. By selling off a portion of his Apple stock now, he's locking in profits at the current tax rates, potentially avoiding higher taxes down the line. Valuation concerns. Apple's stock has skyrocketed in recent years, becoming one of the most valuable companies in the world. While this has been great for investors, it also means that Apple's stock might be overvalued. Buffett has always emphasized the importance of buying stocks with a margin of safety, meaning that the price you pay should be lower than the company's intrinsic value. If Buffett believes that Apple's current price doesn't offer that margin, it makes sense that he would reduce his position. U.S. economic concerns. Another major factor in Buffett's decision is his concern about the U.S. economy. He's been vocal about the country's growing deficit and believes that it could lead to significant economic challenges in the future. If the U.S. economy is heading for a rough patch, Buffett might be looking to reduce his exposure to riskier assets like stocks and move towards safer investments, such as U.S. treasuries, which he sees as offering better returns given the current economic outlook. Debate among analysts. Buffett's move has sparked a heated debate among analysts. Some believe that he's being overly cautious, arguing that Apple is a strong company with a loyal customer base and that its stock will continue to rise over the long term. Others, however, agree with Buffett's concerns, suggesting that the U.S. economy is facing significant headwinds and that investors should be cautious about holding onto stocks at their current valuations. This debate highlights a classic investing dilemma. Should you hold on to a great company even if its stock is expensive, or should you take profits and look for safer or more undervalued opportunities elsewhere? 3. What this could mean to you. Now that we've covered the reasons behind Buffett's decision, let's talk about what this could mean for you as an investor. 1. Understand the risks. Warren Buffett's actions serve as a reminder that even the best companies can be subject to market risks, especially when valuations are high. It's important to regularly review your portfolio and assess whether your investments still align with your financial goals and risk tolerance. 2. Diversification is key. One of Buffett's core investment principles is diversification. While he had a large position in Apple, it was just one part of a diversified portfolio that includes a wide range of companies and assets. Diversifying your investments can help protect you from downturns in any one sector or stock. If Buffett is trimming his position in Apple, it might be a good time for you to consider how diversified your own portfolio is. 3. Consider alternative investments. With Buffett shifting towards U.S. treasuries, it might be worth considering safer, income-generating investments for a portion of your portfolio, especially if you share his concerns about the economy. Bonds, real estate, or even cash reserves can provide stability during uncertain times. The key is to balance the potential for growth with the need for safety. 4. Think long-term. Buffett's strategy has always been about thinking long-term. While short-term market movements can be concerning, it's important to keep a long-term perspective. Selling in a panic or chasing trends can lead to poor investment decisions. Instead, focus on building a portfolio that can weather market fluctuations over the years. Remember, Buffett didn't build his fortune by reacting to every dip in the market. He did it by staying focused on the bigger picture. 4. Wrap up. In conclusion, Warren Buffett's decision to sell a significant portion of his Apple stock is a move driven by concerns about valuation, future tax hikes, and the overall state of the U.S. economy. While some may see this as a warning sign, it's also an opportunity for you to reevaluate your own investments and consider whether they're still aligned with your long-term goals. Investing isn't about following the latest trends or making decisions based on fear. It's about making informed choices that are right for your financial situation. So what should you do in light of Buffett's recent moves? Here are a few key takeaways. Don't panic. Just because Buffett is selling doesn't mean you should. Everyone's financial situation is different, and it's important to make decisions based on your own goals and risk tolerance. Reevaluate your portfolio. Take this opportunity to review your investments and ensure they're still aligned with your long-term goals. Are you diversified enough? Are you comfortable with the risks you're taking? Consider safer investments. If you share Buffett's concerns about the economy, you might want to explore safer investments like bonds or treasuries. These can provide stability in uncertain times. So, what are your thoughts on Warren Buffett's move? Do you think he's right to be cautious, or is he being too pessimistic? Let me know in the comments below, and if you found this video helpful, don't forget to like, share, and subscribe for more insights into investing and personal finance. Stay informed, stay invested, and I'll see you in the next video.